Hey, it's Anthony Meisner.
And this is Jim Marion.
We're going to bring you a national update here on Front Range Facts.
So the big question in everyone's mind is, are mortgage rates going to continue to increase? What is the ceiling essentially on all this Fed action, and where is it headed from here? So we're going to try to attempt to address some of that today.
I think one of the biggest things to look at is just where have 30-year fixed rates gone this year so far, and where are they at now?
Quite a bit higher, right, Anthony? I mean, look at
well,
that
well,
increase.
we're over double,
Yes.
and if you follow this trajectory, I mean, it would be like Bitcoin to the moon, right? But I
Well,
don't think that's the case,
let's
right?
not discuss that right
Yeah,
now.
yeah.
But if you start checking the next slide, then the one thing that's kind of interesting is that it is the biggest year-to-date increase in rates in over 50 years. So it's gone up, over double, as Anthony was saying, and so obviously this is having a huge impact, and kind of a sticker shock to the market. And historically, whenever we see large jumps in either interest rates, like we saw in 2018, where it went up to 5 briefly, or when you see other shocks to the system, like the COVID shutdown, well, you see a period of time, about a 3 month period of time, where people really do kind of freak out and pull back and just do a wait and see approach. So that's not too surprising to see what we've been seeing.
Well, look here. This is some mortgage rate projections. This is awesome. This is the first time we've seen some really good news going into 2023. And this really shows kind of the amortized look at all of the major people that kind of predict these things
Yeah.
for the housing market. And it does show that steady declines in interest rates are pretty bound to happen next year, all the way through fourth quarter, right? We
Yeah.
could get into the fives. That would be brilliant.
It's been kind of this is in line with what Anthony and I have been saying, that if it follows the pattern of like the last 7 recessions, there will be rate drops that happen, roughly 12 to 18 months after the recession begins. But we had some good news too, right, Anthony, that have popped up recently.
We did have some good news. Core CPI actually fell remarkably farther than normal.
This is
And
a big news.
this
Yeah.
is a really big deal because the markets didn't expect this. So, good news in the markets results in fantastic news for home buyers. 0.6% interest rate drop overnight, right?
Yeah. Yeah.
This is brilliant because this brought a lot of confidence to the markets. And now the homeowners are actually well below 7% at the rate where
Yeah,
they're
I
at
mean,
now.
like basically the markets had assumed that there'd be a higher consumer price index, which is a measure of economic inflation, and they had it then come in quite a bit lower than what was expected. So we saw the stock market rally quite a bit at the end of the day yesterday, which was November 10th, and then also here the biggest one-day drop in interest rates since time began. So huge ability to now jump into the market this weekend and get under contract and save yourself a pretty decent chunk of change.
Yeah, and I don't think it'll sit here forever, right? We
Yeah.
probably see this bounce back up a little bit before it
Mhm.
trends down next year.
Yeah.
So this is a really good time to try to go shopping and get your rate
This
locked.
is the weekend, people.
This is it. All right. So is there a recession around the corner? This is the real question everyone's been asking. I keep saying that we're almost there or we should be there, but there's a lot of factors that are very different this time around than most, right?
Yeah.
Number one, yes, we have declining growth, right?
Mhm.
Two straight quarters was like the traditional view of it. So in that case, we would be considered in a recession. But the problem is we have these amazing numbers in employment, right? Our unemployment numbers are as low as they've ever been before. But if you looked at the beginning of the year in January, people said 18% of economists surveyed said that we were headed into a recession. Now 63% in October have said the
Yeah.
same thing. So remarkably higher, and most people are assuming that now. Which is
I think, Anthony and I have stated for the last few months, real estate has been in a recession essentially since rates really jumped up at the
yeah,
end
it
of
really
May.
has. And that being said, let's talk about what happens in a recession with rates. So
Well, prices, yeah,
as home prices change during recession. So in the last recession, we saw a 6% increase in home prices, even though we were in an economic
yeah.
recession. 2008 is really the only anomaly. 2008 was caused by the real estate market. So that being said,
Don't
yeah,
expect prices to really drop for a recession most of the time. And considering the fact that even though 63% of economists now are projecting a recession, it's going to happen. And when it does, most people do project it's going to be more of a mild recession, just to kind of correct some of the extravagances we saw with all the printing of money that occurred during COVID.
absolutely. Now, here is an interesting one. What are home prices going to do over 2023? You know, we were just talking beforehand, and a month ago, these were all much, much higher. People expected 3, 4, 5% increases across the board from these groups.
Mhm.
Zelman has come out and said there's a major supply excess
Yeah,
in the United States,
kind of contrary to
which,
what the data shows.
contrary to what we believe, contrary to what the data says, but that's really pushing this forecast. And I think everybody else is sort of listening into some of this.
Yeah, you know, and the thing that's kind of tricky, I think, about, you know, looking at a graph like this too, is what's the line where these prices are considered dropping? Is it considered like, you
Right.
know, the May peak, you know, kind of time frame of 2022 and price drop off of that, or is it looking at the beginning of where prices were at the beginning of 2022, for example? Because certainly in any time of high inflation prices, at some point it's going to start to go back down. That's what happens with everything. So, you know, of course, there's going to be some hit off of the peak that occurred in the May to July period of time. So I don't really take this with too much, you know, credence that's really going to affect anybody's bottom line. And I think most of the price drops already happened.
I think so too.
Yeah.
I think we've been chasing prices down for the last 6 months or so, and we're nowhere near where we were last year. So we just
Yeah.
lost a lot of that, springtime. And
Between now and the end of the year, it's still going to be some, you know, iffiness with price, but around, you know, mid to late January, it's all kind of back, I think, to steady prices.
All right. So what's this one mean, Jim?
So, you know, a recession doesn't necessarily mean prices are going to go drop in homes, but it always means that mortgage rates are going to happen then with a price decrease. So, as you can see with all these last recessions, you know, you had in 1980 high interest rates, they went down 4.25%. That's, you know, higher than we were at before. 1981, same kind of thing, 5%. But, you know, to see like a 2.25% drop off the highest point in 1991, I think we're, you know, probably going to expect to see something like that over the next 2 years.
I would assume so. Yeah. I mean, this is a good sign for all of our home buyers and getting back out in the marketplace, and for sellers, right? Because right now, as we're kind of seeing that shift, things are changing. But here's the real thing, right? Look at this. The average days on market. So this is active to under contract across the nation. Last year we were at 17. It really plateaued off for most of the year. It was just, it was very, very fast.
Yeah.
And then 2022 happens and it gets more extreme than last year, right? So when we talk about that COVID real estate market, we kind of trended down and trended down. Things got faster and faster. And here we are trying to gradually, come back out of this hyper fast market with ultra low inventory, and we're still moving remarkably quick and way faster than we have any time before.
Pre-pandemic, the market is still moving at quite a fast clip, and that's one of the things that I think is that light at the end of the tunnel. If you're talking to sellers or if you're trying to sell your house, just understand that it's all about pricing it right, and if it prices right, it will sell quickly.
Absolutely. Now, here's the other issue: is nationally, this is kind of pendings by region. So we kind of look at this as U.S. as a whole, 31% decrease in home pendings.
Mm-hmm.
The anomaly being the last couple of years where people shifted around a lot. We're kind of settling into a little bit more of a new norm, made a little bit more extreme by these interest rates, right?
Yeah.
But the West is really kind of leading the pack with a reduction in buyers, right?
Yeah. Well, the West had jumped up in price quite a bit. It already was a more expensive place to live. Any coast kind of living usually is more expensive. So, what is challenging about this is, of course, pendings then equal closings at some point in time. So to see it down by this much, obviously future closings are going to have a pretty massive impact for the next couple months.
Absolutely. Now, here's the other thing. We're talking about going into a real fall market, right? This is the first true fall market that we've really seen in, I would say at least 5 to 8 years. But that means that inventory is going to reduce right now, month over month. There's a change in inventory, but it doesn't really appear that way from a national level, right? If you can look at most of the states out there, they're still having a little bit of inventory rising because of the rate environment, because of what's going on. But the West, just like we were talking about with showings, I think people are pulling back with it, right? They're taking stuff off the market. They don't have to sell. They have a lot of equity because they've had so much price appreciation.
Yeah.
So you should see this change over the next couple of months, where we should see a reduction in inventory, because in a true fall market, people start to take things off the market. They don't sell during the holidays. They don't have to. It's kind of a pain, right? So make that friction at a different time of year.
Yeah, but this is also the resiliency, of the market now that's starting to show its head, right? Where the fact is that we're not having this 2008 flood of inventory hit the market, which is drastically dropping down everyone's price. There's some built-in resiliency we're starting to notice, with this very minimal change in inventory levels.
Absolutely. So let's talk a little bit about resiliency. Here's total number of home sales compared to last year. You can see that, July took a pretty big hit. And as we kind of head down the road of the fall, you're going to start to see traditional fall changes,
Mhm.
right? So you're going to see quite a bit of drop offs in number of sales because of that, because we really have been in a very big kind of plateaued market for a long time. If there was inventory available, people just kept buying and changing
Yeah.
and all that. So the resiliency in the market will show its head for sure, but where are we going to see it, right? I think we're going to see it here in the inventory levels.
Yeah, I mean, I think it's going to be just if you look at the fact that even before the interest rates were going up, we had very serious inventory issues, and that's going to continue because 92% of homeowners out there have a 5% or less interest rate. So it's not
Yeah,
going to
right.
cause any major shifts in inventory over the next 12 to 24 months.
Fair enough.
And
Now,
yeah, at the end of September, prices were still up 41%, compared to the pre-pandemic level. So talk about, the resiliency of the average homeowner. Borrowers who bought their home before the pandemic collectively have $5 trillion more than they did before the pandemic hit. It translates to an equity gain of $92,000 per borrower than in
across the
February of
nation.
2020. Yes, across the nation. So think about like
Yeah.
the gains in the West, or there's some other places like Florida. So it's fantastic resiliency built in this market that people now have a cushion of cash they could dip into rather than sell their home if they need to.
So let's talk a little bit about foreclosure activity and why that also builds into this resilience of the market. Last time we had a big recession, the Great Recession, in fact, we had a
It was
lot of
so great.
foreclosures on
It
the
was so
market.
great.
Yeah. So here we are trending down every single year. We have less and less foreclosure activity because we've had so much market appreciation, right? So people can get out of a home. They don't have to file for bankruptcy. They don't have to go into foreclosure. And that is a really good sign. Now, there's a big part of this, and we'll bounce back and forth here for a second because Jim has some really good points on this one.
Yeah,
But
it's so. Oh, sorry. You
no, go
finish your
ahead.
point,
Yeah.
Anthony. Sorry to step on your toes there. No, what's interesting is if you take the share of borrowers who have borrowed more basically than their home is worth, it's 0.85% of all homeowners out there, and there's 53 million of those homeowners. And then if you look at the 2.75% of those 53 million who have less than 10% equity, well, you add both of those together, and that's about 3.6%. Now, if half of them ended up going into foreclosure, for example, then you'd be at about 2016 levels for foreclosure activity, which
Right.
was
You can see here
933,000. It's
a little bit
not,
less than a million. And
yeah,
honestly, look, blue is good, right?
right, yeah.
Their blue bars
Blue,
mean it's a
blue is
healthy
good,
market.
Anthony. You're right. Yeah,
So
yeah.
either way,
I'm no
that
graph
being said,
expert, but I think blue is good.
but either way, there's a lot of resiliency in the market, and there's no way half of these people ever go into foreclosure, right? It's
No,
just not going to
no,
happen.
no.
So that being said, I think the resilience of this market is absolutely there to stay.
And to dispute kind of some prognosticators who are saying there's too much inventory. Well, this slide from the New York Times created by data from NAR, I think is pretty fascinating because we've grown 40% in the U.S. population since 1982, and yet look at the number of homes that are selling. In August 2022, we're at 1.1 million homes for sale. So these are homes for sale. And we
Right.
peaked in 2007 at 3.4 million, but we broke that several times in the 80s. So we don't have inventory, so we don't have a lot of downward pressure on prices. So it's going to continue to keep a very robust, expensive market as a home buyer.
Absolutely. Now, thank you for joining us today. This is our national update. We're going to break these up for you so you get to see even more of our shining faces. I'm Anthony with Land Title. You can always get me at 303-968-9868 or ameisner@ltgc.com.
And I'm Jim Marion. I'm a realtor here at Coldwell Banker in Colorado, and my phone number is 303-548-0243, or you can shoot me an email at jim@ourcoloradohomes.com. And we will be bringing you the rest of the month a segment on our state level data next, and then our local data after that.
Don't forget, you can reach out to us, the show, at frontrangefacts@email.com if you want our slide deck, or you can always check out our other podcast, Get Real with Blockchain, anywhere you find your
Have a
podcasts.
good one, folks. Thanks.